Hello and welcome back to the Energy Flux podcast. I'm your host, Seb Kennedy, founding editor of Energy Flux, the gas and LNG focused news and analytics platform. I am very excited to be joined on this, the first episode of 2026, by an old energy acquaintance and friend of mine, Victor Ponsford. Victor and I are going to be hooking up on as regular a basis as we can manage to chew over some of the many extreme and wild events occurring in the gas and energy commodity markets. We were inspired to get this mini-series up and running with the events unfolding in the Middle East, and specifically the closure of the Strait of Hormuz, which obviously has prevented the export of LNG and oil from the Middle East. So without further ado, Victor, welcome to the show.
Thanks very much. It's an honor to be here and a pleasure. I've followed you for a long time and your content and your research, and I've always found it very interesting. And it's a great opportunity to speak to someone who knows the gas and LNG markets intimately, and to ask you the questions that I've been considering myself, that I've seen other people asking in the space. And I think it is an incredible moment, because this is the crisis that everyone has feared for years, and yet it's happening, and it seems like nobody's quite prepared for it. But before we jump into that, I should just briefly introduce myself. So I work in communications and external affairs in the energy space. I've been doing that for over 10 years, and I really find the narratives in the energy sector very interesting and very compelling, because I think that they move markets. I think that they shift policy. I think that they can really hook into people's imagination. And at the moment, the narratives that are emerging and have been emerging over the last sort of 4 to 5 years, as we've gone through a series of crises in the energy sector, are really shaping the world that we're living in for the next 10, 20, 30 years, even longer possibly. So it's a really interesting moment to jump on and have a discussion about how the world is responding to this crisis right now, and how those responses are going to play out in the long term.
Yeah, absolutely, and that's a great jumping off point to get right into the thick of what's happening in the commodity markets. And I don't know about you, Victor, but I just look at the yawning chasm between political rhetoric and reality on the ground, and watching market participants trying to bridge that gap. I wrote a line in this week's chart deck. I publish a weekly chart deck in Energy Flux, and the conclusion was that the markets are no longer pricing a single outcome. They're trying to price two radically different futures at once. One in which the Strait of Hormuz simply cannot remain shut for any extended period, because it will precipitate an unprecedented energy shock that will possibly tip the entire global economy into a recession. And the alternative, which is that the Strait of Hormuz can't possibly be opened up again anytime soon, because the US and Israeli military initiative against Iran has opened up this kind of gargantuan quagmire from which neither administration is readily able to extricate themselves from. So why don't we start with that? Everyone wants to know, how long is it going to be closed for? There's no definitive way of knowing. But what's your view about where we are with the Hormuz situation, and how long it's likely to stay closed for?
Well, I think you do have these two opposing positions that are at either end of the spectrum. And I think what's interesting is to sort of, which might indicate how long we have to go through, is to probe who is doing well from the current situation and who isn't doing well. And with energy, there's always the story of two sides, the exporters and the importers. And I think you've done some analysis on who's doing well, which I think we should come to in a minute. But my sort of, and this is very much leaning on my undergraduate days, my understanding about peace is that it's usually achieved when both sides want to sit down, and because they're both in a position of great pain. And so I think as well as exploring who's doing well and who's not doing well, it's really interesting to think about the pain points that people may be subjected to at the moment. But let's first dip into who do you think is doing well in the current crisis?
Yeah, well, anybody on the supply side who has access to oil and LNG volumes that are basically not coming from the Middle East or not coming from behind the Strait of Hormuz. So LNG producers, particularly those with exposure to spot markets, are benefiting extraordinarily from gargantuan windfall profits. So I did run some analysis, you're right, in Energy Flux just last week, which modeled the kind of theoretical profitability of each cargo of US LNG that's shipped over the Atlantic into Europe, or which goes around Africa or through the Panama Canal into Asia. And when the war broke out, then the price of gas on traded hubs like TTF spiked pretty much overnight. And we saw the profitability of a single cargo leaping from around about $25 million to as high as $50 million. The gas immediately becomes that much more valuable in a period of stress, even though the physical markets haven't actually tightened. The futures markets, the spot markets were already pricing in the likely tightening of those global gas balances, and immediately rewarding market participants who were lucky enough or strategic enough, if you like, to be in a position to sell into those spot markets. Now, the longer the strait remains closed for, then the higher prices go, because the more that the gas balance becomes tightened, and the more we shift from a place of expectation of tightening to a reality of physical tightening with fewer molecules in the market. And I did publish a kind of user interactive model, which you can download and plug in your own assumptions, but with the kind of central assumptions around volume and price increasing over the coming months. Then I calculated that at today's prices, that exporters and traders of LNG can accumulate about $870 million per week in windfall rents, and that's profit above the kind of pre-Iran baseline. So if you take the 6 months prior to Iran, you have that baseline average profitability of LNG exports into Europe and Asia. On top of that, now then you're looking at around about $870 million per week, and that figure could increase to as much as 4 billion if the force majeure remains in effect for an entire month.
Gosh, that is a huge number. So that's 4 billion for producers in which country, which regions are you talking about there?
This is only US LNG exports from the lower 48 states of America, and that assumes a kind of around about sort of 60-40 splits between exports into Europe and into Asia. It's only accounts for windfall rents on top of the baseline, so extra profits in the wake of the price spike arising from the Hormuz closure. It doesn't take into account any LNG exports from any other source. So it's just the US LNG exporters.
Okay. And I assume that this means that for US gas producers, exporting via LNG is significantly more profitable than selling through their own hub, which I think is it called the Henry Hub?
Yeah, that's right. The Henry Hub is the kind of traded price of gas in North America, and it always trades at a kind of structural discount to other hubs because the US has such a massive shale gas supply base, which means there's ample supply and the demand can always be absorbed by the availability of those molecules. And in fact, that structural discount is really the foundation for the whole US LNG industry. They're buying feed gas that they put into these liquefaction trains at a price indexed to Henry Hub. They've got the cost of liquefaction, and then they have to then accommodate the cost of shipping and insurance, regasification at the other end. And then that kind of full cost stack, you deduct that from the sales price in Europe, so the TTF hub, or in Asia, JKM. And the difference is your netback, your profitability. And that's exactly what has spiked, because the cost base of US LNG has stayed pretty much the same, regardless of what happened in the Middle East. But the end sales price in Europe and Asia has spiked on the anticipation of there being less LNG at the market. So that's where the windfall rents are coming from.
And when you say that the price has stayed pretty much the same in the US, does that mean that US consumers haven't seen an increase in their gas pricing yet?
No, so Henry Hub really hasn't reacted in any meaningful way to the spike in prices that's affecting Europe and Asia. But yeah, the main reason for that is because they have this enormous shale gas supply infrastructure, and US LNG. It's a big component of the kind of domestic gas balance in America, but it's still only kind of the kind of initial stages of its current growth trajectory. So if there was more liquefaction capacity, then I think you'd see the US importing price volatility from global markets much more rapidly. And because there is a construction boom underway, and America's going to see a huge increase in liquefaction capacity, around about 50% increase this decade alone, I would anticipate when events like this happen in the future, which they inevitably will, you'll see the US domestic market and domestic consumers being impacted more intensely and more quickly from the imports, the connection with the global volatility.
Okay, so at the moment, a lot of headlines about the oil price putting up the price of gasoline at the pump for American consumers, but in terms of gas, they're basically pretty isolated from this. So if decision makers in DC are thinking about domestic voters and their power price, their gas power price, it's not really a factor at the moment.
It's not at the moment. And there is a fairly lively debate around the extent to which LNG exports are expected to drive up prices for the domestic market, for domestic consumers. And there's a small but influential lobby of energy intensive manufacturers who are very much against the expansion of the LNG liquefaction capacity along the US Gulf Coast, because they think that it will drive up costs for them and it will affect their industrial competitiveness. And it stands to reason that the more gas you withdraw, that you take out of the lower 48 states and you liquefy and you load it onto boats and you send it around the world, then the tighter the supply demand balance would become in the lower 48 states. The counter argument is that the higher prices that the US will import from global markets will translate into investment signals in the upstream. So you get more shale gas supply coming online to service those higher prices and capture that higher those higher arbitrages for upstream production. The problem is that new supply tends to have a higher cost base than existing supply, because the US shale patch is a large proportion of it is associated gas. It comes out of the ground with the oil. But if you're talking about drilling new gas only wells, dedicated gas wells, you're going to need a structurally higher gas price for those wells to be economic. And that's where I think this whole argument falls down about there being no impact on prices. Because at some point, if you're saying we have to access new gas acreage that might be further away, it has more shipping costs, then you're going to have to see Henry Hub trading at above sort of $5 per MMBTU compared to around about $2.9, $3 where it is at the moment, and that will materially affect the gas and power market in across most of the United States.
Gosh, okay, so I think that describes pretty well the picture in the US. You've already told us about how the prices on other markets are rising and rising fast, or have risen fast. And I guess that's to the point that there aren't any strategic reserves for LNG and gas in the same way as oil. You can't just get a club of countries together to build up a storage and then release it. Although, of course, Europe does have access to its own storage. It's normally looking to refill it at this time of year. So I think a lot of the commentary is that there's basically a fight for ships and LNG ships between Asia and Europe. How is that contest proceeding?
Yeah, so the contest hasn't really started yet because we're not officially in the refilling season. That normally happens in spring, around about April, May. So Europe is still drawing down from its winter gas stocks and importing LNG to meet current demand for gas. So the problem is that the futures markets are already pricing in that contest from happening. So you look at the forward price of gas for delivery on the TTF, which is the benchmark gas trading hub in Europe, and it's spiked all the way along the forward curve in anticipation that there's going to be this competition with Asia now where there wasn't likely to be, because Asian demand for LNG has been actually surprisingly flat over the last 12 to 18 months. And there was a fairly relaxed view in Europe, which is that, well, Asia just seems to have kind of gone cold on LNG, which gives us a clear run at scooping up all the flexible cargoes of LNG and docking them at European terminals and injecting all of that gas into underground storage. And then we enter the following winter with a really healthy balance of, like, say, 90% full level across all the European gas storage sites. That whole narrative, that whole perception, that whole expectation has been completely upended with the suspension of exports from Qatar, because obviously 20% of the global supply is now missing from the market. And that 20%, the vast majority, I think about 80% of it, went to Asia. So countries like India, China, Thailand, Bangladesh, these are all the countries most exposed to the physical loss of those cargoes. And they're already having to dip into the spot market to replace those cargoes at an immense premium, at a massive extra cost. So the fusion market in Europe is instantly pricing upwards and bidding up the price in anticipation that Europe is going to have to outbid those consumers in Asia in order to be able to refill its gas stocks, or run the risk of going into next winter with perilously low levels of gas held in storage.
So I think at this point it's really interesting to you've got the US as basically the only bulk provider of LNG to the market at the moment, and then you have Europe and Asia lining up to compete for its cargoes. What is Europe uses LNG primarily, I think, to generate power, but is that the case across the whole world? Is everyone using LNG for the same thing?
Well, everyone uses it for different things, don't they? In Europe, there's a kind of semi-integrated gas market, so it just ends up being used for all different purposes that all sources of gas get used for, whether it's pipeline gas, domestic production, or LNG. So yeah, it's split between power generation, residential heating, particularly in winter, and as an industrial feedstock. Those are the three main demand centers or use cases for gas. In Asia, then the heating element is not quite so pronounced, but the industrial aspect is more significant. So in India, for example, the fertilizer sector is a huge consumer of natural gas, and including LNG. And we've seen the Indian government already start rationing gas use, and they've restricted the supply of gas to fertilizer plants to 70% of their demand. So you're going to see 30% of fertilizer production shut in India, according to the current regulation. They're prioritizing domestic consumers so that people don't kind of have to go without. But at the same time, that means something has to give, and it's industry that's being hung out to dry. And that has enormous repercussions because obviously fertilizer exports are essential in the planting season, which we're just coming up to in the northern hemisphere, at least, for crop yields. And so that's why this Hormuz closure has repercussions that go way beyond energy, and they will spill over into things like groceries, food, cost inflation, cost of living, and all of these problems that we kind of had hoped we turned our back on in, I'd say, across the whole world, but particularly Europe after the events of 2022. Well, we could be plunged back into another energy-driven inflationary cost spiral.
Mm. So lots of different uses for LNG. It's not just about keeping homes warm or keeping factories going. And at the moment, it seems like the first answer is either buy more at a higher price or do less. So the demand that's being destroyed at the moment, what happened in the last crisis? Did that demand resurge again afterwards? Or do you think it's basically, even if Qatar LNG comes back on under the most optimistic scenarios, which I guess is sort of 2, 3, 4 weeks, do you think that the damage that's been done is lasting, or do you think it might come back?
So yeah, that's a really interesting question, because I think first of all, we've got to look at the different kinds of damage that are being done. So there's one which is the physical damage to the liquefaction plant itself in Ras Laffan in Qatar, and which experts say can be repaired in like a month or so. And then there's the damage from the higher prices that this period is going to inflict upon consumers, and whether people will simply turn their back on gas. And I think, having had the experience of 2022 so kind of fresh in the memory, and then to be heading into what could be an even bigger gas price shock, it really is going to be a kind of double whammy for particularly policymakers who are thinking strategically about the role of gas in their energy systems, the, the, the viability of using gas, particularly LNG, as an energy transition partner. Because if this is going to happen every 4 years, then it's going to make the energy transition and just running your economy that much more expensive. So I think that tethering your economic fortunes to this extraordinarily volatile commodity, the scales are falling from people's eyes more and more that this is just an incredibly volatile commodity. It doesn't really live up to the purported benefits, which were flexibility, but it's only flexible to the extent that you can outbid the rest of the world when supply tightens, which it invariably does. So I think that's a major, major consideration and a kind of the core epicenter of the damage that's going to emanate from these events for the long-term role of gas in or LNG specifically in particularly emerging markets because they're so price sensitive. Europe kind of just pays whatever and absorbs the cost. I think in emerging markets, it's very much a case of, well, we literally have to go without.
Yeah, which obviously has huge implications when you described earlier how it's essential for fertilizer production, and many of these countries produce food domestically for export, but also to feed their own populations. And so if they can't buy gas to produce fertilizer, to produce food, it starts looking like a bit of an omni crisis. Never mind inflationary increases in prices. It sounds like it could be across the board pretty disastrous. And that's before we even talk about oil.
Yeah, absolutely. But tell me, Victor, like I've talked enough. Like, let's talk a bit about your view of Hormuz and the politics around it, and like the likely duration of this closure and what the political escape routes are for all sides. Have you given this much thought? Because it's the $100 billion question right now, isn't it? It's like, how long does it have to stay closed for? What are the trade-offs that each side is considering, and like how long a closure are we looking at, and what's the critical path?
Yeah, it's a really good question. I think, what's interesting is to see how the narratives that are being put out there really says a lot about where people think the conflict is heading. So where you have analysts putting out optimistic scenarios, that's probably a little bit wishful thinking on their part and may be reflecting an upbeat sort of client-centric view of where things are heading, because I think there is, in the wider energy space, a lot of people invested in the LNG market. And then I think, as I said earlier, and as we've discussed, the pain points for people in DC are pretty abstract and far away, except for the petrol pump price. And even the midterms, which everyone sort of is talking about, still, in my mind, feel quite far away. I think they're in November. So I don't really see on the US side right now sufficient pain to make them, start looking for meaningfully look for a peace solution. And I think on the opposite side, there's been a sort of rolling conflict in the Middle East now for 2 years plus, and there hasn't been much surrender going on of the type that Donald Trump has said he wants to see. So I think that, people are dug in on both sides. And again, I think some of these more optimistic scenarios that have been put out about things returning to normal sooner rather than later have also been followed up with analysis and scenarios around the might and power of the US Navy, which is obviously pretty damn big. But just today we saw that there are strikes happening on cargo ships. And I think it's interesting to just consider the geography of the Strait of Hormuz, which, as I understand, is actually far more narrow and constrained than people had appreciated. And in the recent past, you've had the Houthis hitting ships in the Red Sea, and that was enough to deter shipping and send a lot of vessels all the way around the whole of Africa. So to my mind, I think you see two sides dug in. I think you do see statements coming out of DC that hint at the conflict being, nearly over, or sort of talking about end games and off ramps. But then, actions speak louder than words. There's still a pretty heavy bombing campaign going on. And it seems to me you've got two sides that at least from their actions, do not seem to be anywhere near putting down arms. And I suppose, the other point is that Israel is also a big part of this equation and also doesn't seem to be that keen. Last time, I think it was a 12-day war. We're past 12 days now. I think, it's really hard to see how in the current scenario, DC or Tel Aviv can claim a victory. And I guess they want to be able to claim victory to their domestic audiences. So yeah, it's the $4 billion question, as I said, but I would assume if I had to put money into it, that the current scenario is going to continue for at least some time. And I think that's where it's interesting to hear what the markets are doing. And you described these two different narratives. And I'm wondering if you've got any view or visibility on, the proportion of money that's flowing into the narrative of this is a short-term thing, everything's going to return to normal sooner rather than later, versus actually no, this is long-term and it's going to take some time.
Yeah, so I do have a way of gauging that, and I published this in the Energy Flux chart deck. I have a kind of regression model which I'll try to explain in the most accessible and least boring terms. But basically, this is a kind of data model I've created to understand and decipher where hedge funds are positioning on the forward curve, because obviously they can take positions in the market. It doesn't have to be just the prompt contract. It can be for delivery next month and 3 months, 6 months next year. And basically by analyzing the Commitment of Traders report, which is a regulatory disclosure document which says where traders are positioned in aggregate across all futures, and doing a regression analysis against price movements on specific contracts, specific maturities. So like May, June, July 2026, going into 2027, TTF futures, you can kind of break down and get a feel for where the trading activity is concentrated. So that's a long way of saying I have a clever data tool that kind of gives you a clue about where the hedge funds are placing their bets. Before Iran, they were all betting very heavily on there being a kind of strong procurement of natural gas over this coming summer. And then the kind of outer reaches of the forward curve going into next winter, there was no interest in trading those contracts. Going into 2027, when we are going to have a much greater supply of LNG, then again, there was no real interest in trading those long dated contracts, because I think the narrative and the assumption was we're going to have amply supplied markets. Their gas might even become quite boring. Maybe they're even pivoting into different commodities for the kind of post next winter period. The week after the invasion, then we saw a massive change in the way that the funds are positioning in the forward market. So the hedge funds have gone from trading those kind of prompt and summer 2026 contracts, and now they're showing a really strong renewed interest in much longer dated TTF futures. And I read this to mean that they see that Europe is probably going to not refill its gas storages as high as they would have done without war in Iran this coming year, so in summer 2026, that they're going to essentially kick the gas crisis can down the road, go into next winter with those low storage levels, and then face an even bigger refilling challenge in 2027. And so they're positioning accordingly with these kind of bullish bets that the price will go up in next winter and the following spring and summer in 2027. So essentially, what this data model is saying is that the hedge funds are betting on there being very long-lasting consequences from impacts that have already occurred. And that's not even to assume that Strait of Hormuz remains closed until next year. We're not saying that at all. We're just saying that the current market view of the funds is that the gas market is going to be materially tighter for many, many months, probably going all the way into like the first half of 2027.
Okay, that's fascinating. So they're basically betting that Europe, and I guess the procurement of gas in Europe is mostly done by private companies who require these volumes in order to run their operations, whatever they might be. So they're basically betting that European buyers are going to dither and wait on the hope that things might change.
Yeah, and especially because when you buy gas and put it in storage, you need to hedge You hedge your sale price. And the way you do that is you buy cheap in summer when demand is low, and you hedge your sales in winter when demand is high and price is higher. So you lock in that spread, the summer winter spread. But of course, what happened when the US and Israel started bombing Iran is that the summer winter spread inverted, because the funds immediately assumed that there's going to be an almighty rush for gas in the summer. So that pushed the summer price above winter. So if you buy gas now at today's prices and you lock in the negative spread, then you're looking at carrying hundreds of millions, if not billions of euros of losses in the gas that you've held in underground storage. And I did run some numbers in Energy Flux, and so let's assume, right, that you were to refill European gas storages to 90% full at today's prices and hedge your sales at today's prices for delivery in winter when you take the gas out, and you're looking at, I think it's about €2 billion loss. So nobody's going to do that. No gas storage operator in their right mind is going to buy gas that they know they're going to make a loss on. So the gas refilling simply won't happen. And I think that's why the funds are looking at this and saying, well, okay, if gas storage is uneconomic now, then they're probably going to have to do it in 2027. And so they're kind of betting on that happening later.
Yeah, I think, you see, I think my take on the politics of this is, or maybe this is where the intersection of politics and markets come together, and in particular for people who for traders and others that are watching what politicians and policymakers say, is that there still seems to be some assumption that you have a conventional US government that says what it means and does what it says. And I think whether it's the sort of statement that said that actually the US Navy had escorted I think there was a statement saying that the US Navy had escorted some ships through the Strait of Hormuz. And then I think a few hours later that was backtracked, and you can see a huge swing in the oil price when that happened. And again, the sort of dissonance between the statements coming from the White House and then what's happening on the ground. And yet that's all they have to go on still, right? I mean, that's how it sort of works, is that you have a commander-in-chief who makes statements that are about their intention, and then markets and other people react accordingly. And I think the difficulty here is that you have statements coming out that don't match what's happening on the ground. And at some point, there's going to be a disconnect, or there's going to have to be a sort of reckoning and a realization that, like, we cannot necessarily put full trust in what US president and his administration is saying, because we're going to be losing money, or we're not going to be making as much money as we could have. Does that measure up with what you're seeing or thinking?
Yeah, I mean, the disconnect between the rhetoric and reality, which I think is our opening sort of talking point, it's just phenomenal. And so quite how you're supposed to trade this is unbelievably tricky, because, like you say, every time the US government says something, they're trying to kind of calm market jitters. But then you turn around and you just have to scroll through any social media feed or turn on any news channel, and you're seeing crude oil tankers being blown up in a blaze in the Persian Gulf. So I'm really surprised that the market places as much credence as it does on the words of somebody who's proven to be, at best, an extremely fickle operator, but worth something considerably worse. And still kind of trading and taking these words at face value, like, oh no, he says it's going to stop soon, when all the facts on the ground are to the contrary. But I guess maybe the market knows something that I don't, or they're simply incapable of processing kind of contradictory information from an authority. I'm actually at a loss to understand why oil trades on the rhetoric and it kind of discounts the reality. That's a really interesting one.
Yeah, I mean, I think there is that deferential and sort of time-bound trust in that holders of public offices are going to try and say and act responsibly and think about the markets actively. But at the same time, it's interesting to see how that isn't the case for every country in the world. I saw yesterday, I mean, this is, the other sort of big fossil fuel supplier to international markets is Russia. And I saw that Gazprom had put out a statement about their infrastructure. I don't know if you saw this. And the sort of speculation around this statement, which is that their infrastructure had come under attack.
Yeah, I did see that. Quite an unusual statement from Gazprom. They never really divulged that sort of information, but their communications campaign recently has been very nakedly driven towards engineering a perception of scarcity in Europe, exploiting this moment of weakness on an import-dependent region with which it is de facto at war, and using that leverage to deliver political outcomes for the Kremlin. But you're absolutely right. The whole Ukraine situation, we haven't even touched upon that yet, and maybe we should probably say for another episode. But it is kind of a whole separate dimension to this about how Europe resolves the whole Russian pipeline gas thing while also trying to deliver a kind of lasting and meaningful peace for Ukraine.
Yeah, it's interesting, isn't it? Because they issued that statement yesterday, but I don't think they said a word about this LNG tanker that got sunk off the coast of Malta in sort of mysterious circumstances.
That's right. Although I think that wasn't related to Gazprom. I think that was one of the shadow fleets, so one of the fleet of LNG vessels that gets used to ship sanctioned Russian LNG. But of course, Gazprom doesn't really engage in much LNG trade. And this Novatek, which runs the Siberian LNG projects at Yamal and Arctic LNG too. So it would have been, I think, even more unusual for Gazprom to have commented on that specifically, unless it had been a tanker which had been servicing one of their very small LNG plants. But yeah, that attack, that really did kind of push the envelope on, Ukraine's actions and what's deemed to be kind of acceptable conduct during a military conflict, because obviously an LNG vessel, even if it is carrying sanctioned cargo and it's helping to finance the war effort, it is still not a military asset. And so striking those installations, even though like Russia has obviously been indiscriminately targeting civilian infrastructure in Ukraine, it's like it's problematic for Ukraine, which is kind of striving to adhere to a higher standard of military engagement. But it's incredibly difficult and very complicated area.
I realize we're running low on time, but I think, and there's plenty more to discuss in subsequent episodes, but I do think it's interesting to touch here on the LNG vessel, the Russian LNG vessel being struck reminded me of when Nord Stream 2 got blown up. And then also, I mean, just the more mundane stuff that can happen around gas and LNG, which, there's been outages of LNG facilities in the past in the US, which I think took out double-digit percentages of production. So, looking ahead through the spring, the summer, into the autumn and December, we're already in a tight market. Should any of these things happen, maintenance shutdowns in Norway for piped gas, infrastructure in the US, any further attacks in mysterious places, what do you think the impact of those would be?
So I'll keep it brief because we're up against time, like you said. But basically the whole narrative around a structurally looser market has been at the very least delayed by, I'd say, about a year. So any unforeseen outages, regardless of the cause, is going to have an outsized impact upon prices. You're going to see markets being a lot more jittery for a lot longer. The kind of long lost LNG glut, which I've written about at length in Energy Flux, is it's constantly being kind of pushed to the right. It will arrive, but I'm not placing any bets on quite when we're going to see that kind of those looser market conditions prevail.
Very interesting. So I think that's something for next time. And I think beyond that, we can also talk about what this means for other power sources that maybe are doing well at the moment. And I think we can talk about what happened in 2022 and how much we think that's going to be replicated this time. But I think that's all for another episode.
Absolutely. Yeah, no, there's so much to talk. That's why we're doing this, Victor, and I really appreciate you making the time. Hopefully we'll be hooking up again in the very near future to chew over the latest developments. But let's pause there for now. Any final remarks, Victor, before we sign off?
I just think the last 2 weeks have been fascinating. There's been something every day. We're coming up to the weekend. I think it'll be just as interesting to touch base on this all next week, the week after, because things are moving fast.
Absolutely. Well, yeah, we'll be back together before too long. Just to remind everybody listening to, if you're not already signed up to Energy Flux, go to www.energyflux.news. There's a free newsletter. Go sign up there. There's lots of interesting stuff, deep dives, chart decks, hot takes, and reams and reams and reams of data and charts which explore all the things we've been talking about today. But all that's remaining is for me to thank you, Victor, for joining me, and thank you all for listening, and I'll see you again soon.